Welcome to the weekly review for calendar week 13. And what can I say, this was one of the most intense weeks since I started this channel. Hormuz has been closed for 4 weeks, Brent is at $112, and the fear and greed index is at 10. And that means extreme fear. The S&P is down 7% today, the Magnificent Seven have lost $300 billion in market value, and right in the middle of it all, the Supreme Court overturns. On top of that, tariffs, mega deals in shipping, a class action lawsuit against Hercules Capital, and PayPal has fired its CEO. Today we'll take a compact look at all of this. Let's start with the elephant in the room. The Strait of Hormuz has been effectively closed since March 4th, and that's 4 weeks. 20 million in exports per day simply offline. 280 tankers are stuck in the Persian Gulf. Insurers have completely withdrawn war risk coverage. Trump on the 26th of March extended his ultimatum to Iran. The new deadline here is April 6th. April. Quote, "Open Hormuz or your power plants will be destroyed." Iran says, "We will not negotiate." The Houthis continue to attack Israel. US troops are being increased. At present, there is no end in sight here. And now it gets really interesting. Take a look at the Brent price trend. Before the conflict, we were at $71 to $76. On the 8th March, for the first time in 4 years, we broke through the $100 mark. On the 27th March, the closing price was $112, up 4.2% in a single day. The intraday peak was even at $126. The markets are trading based on very little information. The supply shock is not yet priced in, despite a 60% price increase. And that's what Chevron CEO Mike Wirtz says. 20% of global petrochemical capacity is offline. Even if Hormuz comes back online tomorrow, recovery will take 250 to 275 days. Prices will remain elevated until the end of the year. And that's not just anyone saying this. That was said by Dow CEO Jim Fitterling. And you really have to let that sink in for a moment. The IEA has released 400 million barrels of emergency reserves. That sounds like a lot, but with 11 million barrels per day offline, it's not nearly enough. Not even close. VLCC tanker rates have reached an all-time high, $423,736 per day. Spot rates have increased by 400%. Since December, LNG Spark Atlantic rates jumped 163% in a single day to $161,750. Largest single day increase ever in oil stocks per day. Exxon at $630 billion market capitalization, Chevron at $379 billion, and Shell at $246 billion. ConocoPhillips has a 9.19 rating from analysts, the strongest sentiment among the majors. And Dino Arthur made an asset swap with Equinor on March 16th. 19% in Atlantis plus 10% in Aphrodite. Both are gas condensate fields in the North Sea, with production starting here at the end of 2009 and 2020. And since we're already talking about the big deals, shipping saw 2 mega acquisitions this week. Number 1 is clear. Hapag-Lloyd is buying ZIM for $4.2 billion, $35 per share, all cash. That's a premium of 58%. ZIM is currently trading at just under $29, which is 17% below the offer price. And that's the uncertainty priced in. Interestingly, a new ZIM will be established as an Israeli liner company with 16 ships, with closing expected by the end of 2026. Number 2, Diana Shipping is raising its takeover offer for Genco to $23.50 per share. In partnership with Starbulk is acquiring 16 Genco ships for $470 million, with financing commitments totaling $1.4 billion. And that's pure consolidation, plain and simple, and flex. LNG3. Open ships in the hottest spot market of all time. Up 10% in the last month, up 24% over 3 months. Contract extension and fleet update came on the 23rd March. But when? When will the market for LNG exports open up again? It's highly uncertain, and that's exactly what they themselves are saying. Global Ship Lease has published its annual report. 71 ships. $2.24 billion in contracted revenue, with an average remaining charter duration of 2.7 years, including charter options even up to $2.77 billion. And that's a solid foundation. Container rates have risen by 30% overall since the start of the war. Middle East routes up 40.8% in just 1 week. SCFI up 14.9%. Surprisingly, dry bulk has remained stable even though Hormuz transits have collapsed by 91%. From my MB Finance mate, we currently see a payout month for special dividends this month. Shipping sector, and historically the numbers tend to be strong in March. Overall conclusion for shipping, currently a strong increase along with a recovery. Personally, I would buy more on dips here. And now I'll show you something really exciting from my dashboard. The sector rotation is as clear as it rarely ever is. Energy XLE up 41% in 3 months. That's 49 percentage points, above the S&P 500. Massive inflow, commodities up 14.8% over SPDR, utilities up 14.6%, consumer staples up 12.8%, everything is flowing in here. On the other hand, technology is down 11.2%, 3 points worse than SPDR. Consumer discretionary down 13.8%, and financials are the weakest sector at minus 14.2%. 6 points below Spider. Capital is flowing out of tech and finance and into hard assets, right where we are positioned. My crash early warning system shows a crash score of 1 out of 10. No acute signal. The yield curve is at plus 0.56%, so it's in the reinvestment zone. High yield spreads at 321 basis points. Quiet. SAM rule is at 0.27 below the trigger. Financial stress index negative. At the moment, everything is green, but, and this is important, the cycle position shows month 41 out of an average of 53. We have used up 78% of the historical bull market, and the reinvestment quota is at 100%. The danger window has completely passed. 6 out of 8 post-war recessions happened exactly in this window. That doesn't mean the crash will come tomorrow, but we are currently in the late cycle, and we should simply keep that in mind. At the moment, I have my cash position at just over 10%. My portfolio is perfectly positioned for this rotation with 26.8% in energy, 24.7% in shipping, and 13.6% in mining. Now in the inflow area, we come to the central banks and the tariffs on the 18th March. Interest rates were kept at 3.5 to 3.75% with a vote of 11-1. The dot plot shows a rate cut in 2026 and another one in 2027. PCE inflation at 2.7%, BEP forecast at plus 2.4%. The official wording is that uncertainty has increased significantly. ECB 1 day later. The deposit facility remains at 2%. Inflation for 2026 has been revised up to 2.6%. Of course, because of energy, current growth forecasts have been downgraded to just 0.9%. Europe is suffering more from the oil crisis than the USA. And then the bombshell of the week. The Supreme Court overturns Trump's renewable energy tariffs 6-3. This is the biggest trade policy decision in decades. Refunds have been ordered. Trump now has to completely restructure and is switching to Section 301 and 232 as of the 11th March. Section 301 against China and the EU due to overcapacity on the 12th March. Again, Section 301 against 60 economies and on the 24th March. And now you have to pay attention. Section 232 auto parts tariffs, deadline there from the 1st to the 14th of April. And this hits VW directly. Oh, and by the way, Paul calculated this week that the Treasury has $47.78 trillion in liabilities against $6 trillion in assets, including unfunded obligations. With Social Security and Medicare, we're at over $136 trillion. His solution here? Cut by 6% per year over 5 years. Well, that's certainly ambitious. Now let's move on to REITs and pipelines, and here I have to preface things with a bit of a warning. REITs are currently under a lot of pressure simply because interest rates are being kept higher for longer than was priced in. At the moment, many rates are also at a 52-week low. Back then, I was considering getting in at the end of 2026 because if you see that interest rates are being lowered, that's really beneficial for the REITs. Currently, since rates are being kept higher for longer, I have to take a look at how the fundamentals of all the REITs are holding up. It could even be that one of them will say yes to me. My next playlist will simply be for the reason that many REITs are currently at their lowest point. That could probably provide the greatest added value for you. If I show you my positions, the ones I currently hold, you can just take a look at them. Just quickly write in the comments what you think about it, and just briefly in advance, if you like the video, please give it a thumbs up. And if you're not a subscriber yet, I would really appreciate it at this point if you subscribe now. Otherwise, regarding Cameco, the ex-dividend date is March 31st. March 31st, so that's on Monday. So if you wanted the dividend here, you would have had to buy on Friday. Otherwise, with Team, you can get in at any time anyway. Maybe also here with Team. In my opinion, is it actually coming? One of the safest REITs simply because they are so large and established, and they even pay monthly, which is actually quite nice. Otherwise, 670 consecutive monthly dividends, 134 increases since the NYSE listing. And that's just a stable machine. Kids tomorrow yesterday. Bidder guidance, 8.7 billion up 4%, EPS $1.37 up 8%. And this is the 9th consecutive dividend increase, and another stock I don't want to withhold from you. Innovative Industrial Property Trust. It's a stock that rents out properties. Specifically, it specializes in rental properties in the cannabis sector. The stock has also dropped significantly recently, but here we get 17 euros in dividends. It's also a very high payer. Feel free to take a look at the stock. As I said, it's currently a bit under the knife, so you have to take a look at how the fundamentals are looking. But if you're interested, I only have 3 more episodes left, so I can gladly cover the REITs next. Otherwise, my opinion on commodities, gold is at $4,434. That's 10% below the all-time high of $5,589 from January. Profit taking despite the crisis. B2 Gold launched on the 19th. March saw significant losses with gold falling 5% in a single day. Copper is at $12,951 per ton, which is a 38.8% increase year over year, driven precisely because of the energy transition and data centers. Iron ore is trading at just under $101 per ton. Deutsche Bank forecasts $102 for the full year 2026. If you want to take a closer look at the topic, feel free to watch my video on it. It's called Commodity Supercycle, and in it I worked based on facts, so feel free to check it out. It clearly shows that we will remain dependent on oil, gas and the like for quite some time, in my opinion. And it's even expected that the peak won't be reached until around 2030. Until then, the amount we ultimately need will actually continue to rise. Feel free to take a look for yourself. Silver is down 20.7%, particularly weak over the past month, especially mining stocks over the last 6 months. Rio Tinto up 65.7% with a 4.4% yield, BHP up 39.9%, up 47% with almost a 7% yield. And Nilo is the absolute star in my portfolio. With a total return of plus 339%, we now come to the BDCs and the dividends, and this is where things get a bit uncomfortable. Hercules Capital, 10.27% yield, one of my cash machines so to speak, but here too there is ultimately increased risk, and that's why it's a smaller position. It has been hit with a class action lawsuit. Gainley McKenna has filed a lawsuit alleging that Hercules exaggerated due diligence in deal sourcing and portfolio valuation and made misleading statements about business operations. My assessment: class actions like this can be filed routinely. Often, there's no substance behind them. Still, you have to keep an eye on it and simply watch to see if something is actually found here. Main Street Capital is more solid in this regard, having increased its Q1 monthly dividend to 26 cents, up 4% year over year, and paid out a special dividend of 30 cents per share on the 27th March. Annualized, this comes to 7.6% at $56. Ares Capital remains stable with an 8.92% yield, and currently there is no class action risk. But what really concerns me, Goldman Sachs CEO David Solomon is warning of a private credit crisis. The market has grown to $1 trillion. Blue Owl Capital is down 39% year to date. Blackstone and Morgan Stanley are restricting investor withdrawals. 1. If this thing collapses, it will spill over into traditional banks. And this is being watched very closely. And I have mentioned this before as well. Dividend news on the side. AT&T has confirmed a 27.7 cents quarterly dividend. Payment here on the 1st of May. And CVS Health has confirmed 66 cents. Payment here is on the 4th of May. So let's move on to PayPal. A complete mess. CEO Alex Chriss was fired on February 3rd. On the same day, the stock dropped by 20%. $10 billion in market value wiped out in a single day. The 2027 guidance targets have been completely withdrawn, and since then, 4 class action lawsuits have been filed. The first plaintiff is plaintiff on the 20th of April. Allegations, false statements about revenue, outlook, branded checkout, and Salesforce capacities. The share price is around $40. That's minus 14% in 30 days and minus 40% over the year. Market capitalization is now only $41 billion. Motley Fool wrote an article, "Don't buy until 3 things happen." Account growth is only up 1% year over year. The take rate has dropped from 2.89 to 1.66%. And that's correct, so let's move on to Bayer. The shares are currently at 38 euros and the roundup settlement of $7.25 billion has been provisionally approved. 65,000 lawsuits, final hearing on June 4th. Will there be an admission of guilt in July? And that could be the turning point for the stock. Lufthansa at 7.35 euros, struggling with soaring kerosene prices. Jet fuel is 57% more expensive. VW faces tariff risks due to Section 232 auto parts tariffs starting in April. PBF Energy. The SVP did sell 50,000 shares for 2.24 million but still holds 183,000 shares. And refining margins are recovering, 4th quarter earnings were beaten, and at the moment that's a political signal. Now let's take a quick look at my portfolio. At the moment, I have about 94,000 euros invested here, with 76,000 euros as total return plus 25,540 euros, which is currently a gain of 32.2% with 239 positions. However, I will definitely slim these down, but there will be more on this in the next portfolio update. So let's just quickly move on to the summary. I think we've definitely already seen a lot here. I've already given you a few insights here as well. Yeah, sure, repeating things twice is usually better. Okay, otherwise, as I said, the summary. 1. Hormuz week 4, no end in sight. The 6th, April is the next trigger. Chevron CEO says it's not priced in. 2. Oil stocks and tankers are the biggest winners. VLCC all-time high, XLE up 41% in 3 months. 3rd, shipping is consolidating aggressively. Hafer is buying ZIM, Diana is going after Genco, and those who aren't buying are being bought here. 4th, Supreme Court kills the e-tariffs. Trump has to restructure auto tariffs starting in April. 5thly, the Fiat and Creed index is at 10, a historically good contrarian entry point, but the reinvestment clock is at 100% 6. Hercules received a class action penalty. The stock is currently solid, especially with the special dividend. And Goldman Sachs warns against private credit. 7. PayPal is a mess. CEO ousted, 4 lawsuits filed, 10 billion euros destroyed here. Yes, otherwise that's it for my weekly review. If you enjoyed it, please give it a thumbs up. If you haven't subscribed yet, I would really appreciate a subscription at this point. Otherwise, feel free to write in the comments how you assess the situation. For example, let me know what you would like to see improved here with my setup. Where would you maybe like to know a bit more, or what would you like to know? Just write it in the comments. Otherwise, I can improve or optimize or deliver the content that you ultimately want to see. That's also important for me. Otherwise, if you say everything is fine, I'm also happy to get some quick feedback. So yes, everything's fine. The length is also very good. I just need to know, otherwise I can't make any adjustments. Otherwise, right now it's even a new camera. As I said, I always try to improve and optimize my content a bit. No master has ever fallen from the sky, which means my learning curve is always steady, not exponential. just as a tip for you. Otherwise, as always, this is not investment advice, but just my personal strategy. Everyone should do their own research. I wish you all successful investing and see you in the next video.